Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Forward Contracts, a guide to mastering financial flexibility. Ever wonder how businesses lock in future prices to avoid market volatility? That's where forward contracts come into play. These agreements allow companies to fix costs and manage risks, providing much-needed stability in unpredictable markets. This video will help you understand the fundamentals of forward contracts, why they're a crucial tool in financial planning, and how they can impact your business strategies. Whether you're a seasoned investor or just curious, you'll walk away with a solid grasp of how forward contracts can protect financial interests. Let's dive into the world of financial foresight. Understanding forward contracts. Forward contracts are essential tools in the financial toolkit, helping businesses and individuals manage risk. They open a doorway to a world where you can lock in prices today for transactions that will happen tomorrow. Curious about how they work or why they matter? Let's break it down. Definition of forward contracts. A forward contract is a private agreement between two parties to buy or sell an asset at a set price on a future date. Unlike standard contracts traded on exchanges, forward contracts are customized to meet the needs of the parties involved. This flexibility allows them to be tailored precisely to what each side wants. However, it also means they carry a bit more risk since there's no central marketplace involved. How forward contracts operate. How do these contracts actually work? Think of it as a handshake deal with terms written in stone, but with a timeline attached. Here's the basic structure. Negotiation phase. Two parties come together to decide on the terms. This includes pricing, quantity and delivery date. Need 1,000 bushels of wheat in 6 months? You can set the price now, avoiding future market fluctuations. Agreement. Once the terms are set, both parties commit. This agreement isn't just scribbles on paper, it's a binding commitment that both sides must honor. Maturity date. When the contract reaches the specified date, the agreed transaction takes place. The seller delivers the asset and the buyer pays the pre-agreed price. This means no second guessing or renegotiating. Forward contracts serve as financial safety nets. They help companies avoid nasty surprises in their budgets by ensuring cost predictions are spot on. Whether it's locking in a currency exchange rate or securing the price of raw materials, forward contracts provide a layer of certainty in an otherwise unpredictable market. Have you ever wondered how companies avoid disaster when prices swing wildly? They have the foresight to use forward contracts. While they're immensely valuable, keep in mind that they require trust and confidence between parties since they don't have the safety net of an exchange. In the end, forward contracts are like an umbrella on a rainy day, unseen until you really, truly need them. Types of forward contracts. Forward contracts are essential financial tools that allow companies and individuals to lock in prices for future transactions. These agreements help manage risk, but not all forward contracts are the same. They come in various types, each suited to different needs and situations. Let's dive into the main types and explore their unique features. Standard forward contracts. Standard forward contracts are like the fast food menu of financial agreements. They're straightforward and easily accessible. These contracts follow a typical predefined structure. Here are their key characteristics. Fixed terms. Standard forwards have set terms like quantity, price, and delivery date. These are agreed upon at the outset and don't change. Market comparisons. They're often based on common market conditions and are priced in line with prevailing rates. Ease of use. Because of their simplicity, standard forwards are widely used and understood in the financial sector. Think of them as grabbing a burger from a known chain. There are fewer surprises since everything is predefined. Customized forward contracts. On the other hand, customized forward contracts are like a bespoke suit. They are tailored to fit the specific needs of the parties involved. Here's how they differ. Flexibility. Parties can negotiate every aspect, including the amount, delivery terms, and even specific conditions or clauses. Specific needs. These contracts cater to unique requirements that aren't covered by standard agreements, providing a more precise fit for distinctive situations. Complexity. Because they're customized, they're usually more complex and might require legal advice to draft. While they offer the advantage of specificity, the complexity increases the risk. Much like crafting a tailored suit takes more time and expertise. Cash-settled versus physically settled forwards. When thinking about contract settlements, it's crucial to recognize the distinction between cash-settled and physically settled forward contracts. Let's break it down. Cash-settled. Forwards. Imagine settling a bet. Instead of exchanging the physical commodity, the difference between the contract price and the market price at maturity is settled in cash. This option is common when dealing with financial instruments like stock indices or currencies. It's convenient and prevents the need for physical delivery logistics. Physically settled forwards. This is akin to purchasing a car online and expecting it delivered to your doorstep. In physically settled forwards, the actual asset, such as gold or oil, is delivered upon maturity. This type is used when the goal is to actually obtain the commodity. Each type of settlement serves different needs. Cash settlement removes the hassle of moving goods, while physical settlement satisfies those who need the tangible asset. Understanding the types of forward contracts is like knowing when to use a smartphone versus a computer. It's all about knowing which tool fits your need best. Market participants in forward contracts. Forward contracts are financial tools used by different market players. They give these players a way to set prices for future trades. But who are these participants, and why do they use forward contracts? Let's break it down into two main groups: hedgers and speculators. Hedgers. Hedgers are like the cautious drivers on a busy road. They use forward contracts to avoid bumps in the market. These participants include businesses and farmers who want to lock in prices for their products or raw materials. Imagine a farmer growing wheat. The price of wheat can go up or down, making it risky to predict earnings for the harvest. By using a forward contract, that farmer can agree to sell wheat at a set price in the future, no matter what the market price is when harvest time comes. This price lock helps them plan and budget without sweating over market swings. Hedgers aim to protect against price changes. They reduce the impact of price fluctuations. Ensure steady income. By fixing future prices, they stabilize their earnings. Plan better. With less uncertainty, they can focus on improving their operations instead of worrying about the market. Speculators. Speculators, on the other hand, are like thrill seekers who enjoy the twists and turns of a roller coaster. They use forward contracts hoping to profit from market changes. These folks aren't interested in the actual goods, only in making money from the price differences. Picture an investor who expects the price of oil to rise in 6 months. By entering a forward contract, they agree to buy oil at today's price, betting it will be higher when the contract expires. If their gamble pays off, they secure the oil at a lower price and can sell it at the higher market value. Speculators focus on taking risks for profit. They embrace uncertainty, hoping for profitable returns, capitalizing on price movements. By predicting market trends, they aim to make money off the differences. Enhancing portfolio growth. Successful speculation can lead to substantial gains. In summary, hedgers and speculators play distinct roles in forward contracts. Hedgers seek safety, while speculators chase opportunities. Each group benefits from the unique features of forward contracts, using them to their advantage in the ever-changing financial landscape. Advantages of forward contracts. For anyone involved in business or finance, forward contracts can be vital tools. These contracts offer a way to manage future payments by establishing a clear agreement now. Let's explore some key benefits, digging into why they're so appealing to those in the know. Price locking. Imagine trying to nail down costs in a changing market. Forward contracts are like the superhero of your budget, locking in prices so you can forecast with confidence. When you agree to a forward contract, you set today's price for a future transaction. This means you can avoid the surprise of price jumps later on. Stability protects against price fluctuations. Budgeting makes future financial planning easier and more predictable. Risk management shields you from unfavorable changes in the market. Think of it like reserving concert tickets months in advance. You pay the same price regardless of how much ticket demand rises closer to the event. Flexibility in terms. Standard contracts can be a little stiff. With forward contracts, it's like you're the chef in the kitchen, customizing the recipe to meet your exact needs. You decide on key elements like the price, quantity, and delivery date as per your requirements. Tailored agreements specify terms that match your unique business goals. Negotiable conditions discuss and agree on terms that suit both parties. Variety of uses apply to different kinds of goods and timing. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.